Hi, my name is Dave Simonson and I'm one of the directors of Channel Equity Finance. Today I'm going to talk to you about the pros and cons of equity and debt. This doesn't constitute any advice or recommendation either way, we're just trying to explain so we can improve your understanding. To raise money for your business, you must decide whether you want to borrow money or sell ownership interests to equity investors. Often you may not have many options. The person with money to lend or invest will obviously have a lot to say about it. But you should understand the pros and cons of choosing one over the other. So let's talk about debt. Borrowing money to fund your business has many advantages. Often you'll borrow this money from a friend or family member. But if you're lucky, you may be able to borrow from a commercial lender too. So the pros of debt, the main advantage of borrowing money is that while the lender will charge you interest for using the money, the lender won't have any say in how you manage or run your business. More importantly, a lender won't be entitled to any of the profits you make. All you have to do is to repay the loan on time, and in addition you can typically deduct the interest payments but not principal repayments as a business expense. If you can borrow money from a friend or family member, you'll typically pay a lower rate of interest than if you borrow from a commercial lender, and you can avoid paying the loan fees commercial lenders tend to charge. As an added bonus, you may be able to negotiate more flexible repayment terms than a commercial lender would permit. So the cons of debt. If you borrow money, you may be overcommitting your business to a fairly large business expense. You may have to make loan repayments when your need for cash is greatest, usually during your business startup or expansion. And if you have problems paying the loan back or keeping up with the payments, you can ruin your relationship with family or friends. If you borrow from a commercial lender, the lender may require you to put up security for the loan. If you put up business property as security for the loan and your business slows down or doesn't take off and you can't make loan repayments, you may lose these valuable assets just when you need them most. Even if you organise your business as a corporation or a limited liability company, each of which provides owners with limited liability for business debts, almost all commercial lenders will require you, as the owner of the new or small business, to personally guarantee the loan and or put up personal assets to cover the loan, which wipes out this limited liability. So equity investors, if you have friends, family or other people who want to invest in your business outright or become part-time owners, instead of simply lending you the money, you can raise money for your small business this way too. However, allowing people called equity investors to own part of your business comes with its own set of advantages and disadvantages. The pros of equity investors are, first, there's a good practical reason to take investments. Raising money through equity investors allows you to use your cash to pay business startup expenses rather than the large loan repayments. And unlike a loan, if your business loses money or goes broke, you probably won't have to repay your investor that initial investment. As long as you're thoroughly disclosed the risks involved in your business, your investors should understand and accept they are not guaranteed to get their money back. Further, investors often have business experience that can add additional valuable advice and moral support and assistance in growing your business. So the cons of equity investors: on the downside, equity investors usually end up taking a large share of your business profits than a bank or other lender. Since an investor is at greater risk of losing his or her investment, you have to compensate the investor for this risk with a bigger payoff. In addition, your investor will be co-owners and they have a legal right to be informed about all significant business events as well as the right to ethical management. Your co-owners can and probably will sue you if they feel you are compromising their rights. This means you have always a responsibility to take your investors' interests into account when you make business decisions, even if it's not what's best for you as a person. Debt or investors? Which should you choose? If you're trying to finance a startup venture, it's better to seek equity investment because you generally only have to repay investors if the business turns a profit. For ongoing needs, loans are better for businesses with cash flow allows for realistic repayment schedules and for business that can attain the loan without jeopardising personal assets. However, it very much depends on the terms on which each funder will lend to you, so you need to keep an eye on that and an open mind. I hope this video has been of use to you and given you a better understanding between the equity and debt, and look forward to catching up real soon.